Hi, this is Keith Schneider. This is December 23rd edition of Market Outlook. I want to wish everybody a happy holiday, and as we are winding down the year, lots of interesting things are occurring in the markets, and we'll drill down to that in a moment. Also, please be sure to sign up for our investor sentiment survey, and we'll be sure to send you the results. So, in terms of some of the interesting shifts in the marketplace, let's take a look. First, let's cover some of the market internals and where we are with that, because that's also painting an interesting picture. So first thing, on our chart here, you can see we have a chart of the S&P, the Qs, and there are a bunch of short-term indicators that are combined into one indicator. And as you can see, we turned relatively neutral on a short-term basis. However, looking at the overall phase of the market and the other market internals, the indicators are basically extremely positive on the longer term. So for swing to position trades, this has been in a positive mode ever since November 16th, when we generated a buy signal over here. So a little bit neutral on the very short term. Obviously, we got a little bit ahead of ourselves on the last rally up to the 145 area. Let's take a look at the Qs. The Qs, telling a little bit different story. We're marginally positive in both the short and the longer term time frame. So for those day traders, the bias is slightly positive, and the same thing with the Qs for swing to position trades. And as you can see, we basically closed right at the 200-day moving average on Friday, which is, right at the 50-day moving average on Friday. We gapped through both the 200 and the 50. So interesting setup. But again, the more critical point is the absolute lows that were put in about 2 weeks ago. And that's been offering some really good support. As you can see, we opened up lower. We had a fairly decent size wick on the candle, came back to close above this declining 50. So NASDAQ definitely looking a lot more iffy, but its overall position not quite as overbought in the short term, therefore a little bit more favorable there. And on the longer term view, not quite as positive as the S&P overall. Okay, let's take a look at some other details on the market internals. Well, for one, you can see the McClellan oscillator. We got overbought late in November. We've pretty much stayed that way, and you can see we've sort of been up to sideways since that signal. However, more interestingly is that we have generated a new sell signal on the shorter term indicators in the spiders. So this is some of the details from the other chart, and here they are. You can see that the advanced declines definitely running out of steam as we made new highs, and is now turned down above the area that we would consider overbought. And the same thing for volume. So running out of a little bit of gas and turning down on volume, closing under the 10-day moving average, but well above the 50 and the 200. So overall, sort of a mixed bag. Short term under pressure, longer term still looking a little bit better on the composite. Now let's take a look at the Dow. And this is sort of a longer term view. You can use some of this going into next year. Starting off with the weekly chart, you can see going back to 2009, you have a very interesting channel here. The channel is still intact. We tested it late in mid-November, bounced off of it nicely in conjunction with an oversold condition in the RSI. So here we are, and we've been following this channel. So for those that are bullish, our projections would be first that the top end of this trading range here that started in 2011 gets stopped out around the 135 to 136 level in the Dow. And if we can punch through there, our major resistance is going to be the old highs, right, which also coincides with this top end of the channel. But if we bust out of there, you're talking about 155, 160, or even higher if we get a little momentum to the upside. So that's the story on the upside. Some of the upside projections. Now let's also take a look at what's happening here if we break and fall through this rising 65-week average. We'll be taking out the trend line at the same time, so you're going to have the convergence of two important indicators here, right? The 65-week moving average and the long-term trend line that's been intact since 2008 or 2009. So we definitely want to watch that 127 level as important support, but more importantly, the convergence of the trend line, and that low is about the 125 level. So 125 in the DIA, really, really critical. And if we break through there, that would be breaking a long-term trend line that's been intact for 3 to 4 years or more. So that's important to watch. First level of support would be around the 112 to the 110 level. Also, notice how the 200-week moving average coincides with the parallel of the channel that has been created off of these highs up here. You've got this channel that I'm pointing to right here. So interesting projection would be support around that 112 level in the DIA. So that's a good 20-point move. That's a good size drop, but certainly potential. And so those are the critical levels that we have to watch. Let's take a look at the daily chart and if there's anything to notice there. Well, on the daily chart, you can see we're neither overbought nor oversold on our short-term RSI. However, we are holding the 50-day moving average. It is declining, but we're also trading nicely above this 200-day, which is flat. So overall, the trend and price looks intact, but again, we want to be careful because a violation of this 200-day would not be good, and it would probably augur in a potential test of the recent lows. So those are the critical points to watch. We really should be holding that 200-day moving average, and if not, watch out. Now, the thing to be aware of is this divergence between gold and the markets. Now, if we take a look at gold, you can see that we have been trading in this very, very nice channel. This week, we really plummeted. And so there's been an important divergence between gold and the S&P. Normally, they've been both going up with either a drop in the dollar and an increase in bond prices because of the issue about inflation and liquidity pouring into both of these markets. But interestingly enough, even with QE4, gold has done the opposite of what most people have been expecting. Now, interesting, forgetting about the economic analysis of the cause and effect on prices of gold based on inflation expectations and the monetary policy of the Fed, the issue here is, look at that momentum of the 50-day moving average. We basically turned a slight rally above that flat 50-day moving average, it's now turned down. Also take note that while this has happened, the 200-day moving average has been fading as well. Good volume on the sell-off. Now, part of the sell-off is definitely John Paulson, the guy who made billions and is running, I don't know, $20 billion or so, has had a rough go of it, and his gold fund is actually down on the year and was hit with redemptions. So it might be largely technical about the recent drop. But on the other hand, it's certainly interesting once we get to bonds as to what's happened there as well. So when we talk about these shifts, this relationship between gold and S&P is definitely diverging. Now that's a good sign. If the stock market can go up and gold can go down, it means that it's breaking its most recent or multi-year relationship, which is, as I mentioned before, gold and S&P going up because of liquidity pouring in. If there's liquidity coming out of gold or money coming out of gold while the S&P is holding up, that's an important shift. If that sustains itself, that's a really good sign overall for the market and the economy. Now let's take a look at some of the short-term stuff that's developing here as well. First of all, you sort of have a key reversal pattern right under that 200-day moving average that was also broken this week. So it's interesting. You're oversold. You hit the bottom of the channel. Certainly you can have a pop rally off of this, but the important thing is that you are in this down channel here with the 200, with the 50-day failing. So interesting. So you can certainly see a short-term counter trend rally off of this channel. So on the other hand, if we fail through this, the recent low that was put in, and violate this channel, you can really have a major sell-off. Let's take a look at the weekly charts and see where we might end up if that happens. As you can see, once we had that summer and fall rally, gold has stalled. We're now trading under that 65-week moving average, and the 200-week MA is all the way down here. So if you got a throwback to this breakout trend line, it would also should find support around the 150 to 153 level in GLD. And again, if we just go back to the daily chart, I would expect that this rally would find pause somewhere around the declining 50 if we pop through it, and this declining upper channel line right here as well. And you can see we've had some significant liquidation of gold holdings here on these big sell-off days. So this is definitely an interesting segment to watch as it relates overall to the market. Also, now let's take a look at TLTs. Let's see here. Okay, even with QE4 announced, which would normally cause these TLTs to rise, as you see we've been doing overall in the longer term trend, you actually had a really bad showing for some of the auctions for some of these treasuries, and the market sold off sharply. Now we did recover. We're testing this rising 200-day moving average, the 50-day moving average starting to turn down, but we definitely have a confirmed negative phase change. So this is also interesting. The fact is that for the way the market had been acting is bonds, as they went up, would also put a pop into the S&P or the U.S. equities, and actually equities has handedly outperformed bonds over the last several months, which is also a overall positive sign for the economy and the market as a whole. If it can wean itself off of continued priming by the Fed, that would be a good thing. So at any rate, you can see the market's under pressure here. Be interesting to see what happens if we keep this intact. Again, we're into pretty heavy resistance at that 123.50 level. You can see that's been sort of a swing area. Let me put that that area in here. So you can see that we've swung around this, I guess it's around 124 actually, a little bit higher. So again, we could pop through, possibly try to a little bit of a breakout, but overall it seems like that this great many decade run in interest rates is certainly losing steam at a minimum. Let's take a look at the weekly chart, and then we'll wrap it up by going to look at the dollar. Okay, on the weekly chart, you can see we attacked the 65-week moving average, bounced off of it. And again, this level right here, really, really critical. That 65-week, and if we can break under that, you might say that the longer-term trend has potentially shifted. At this point, still intact on a longer-term basis, right? We're trading above that 65-week moving average. Let's draw this horizontal line in here. And we can see that we're now trading under that sort of swing point. Let's get a little bit more precise on a closing basis. So basically, interestingly, this week we closed right on sort of this critical swing level. If we can get another weekly close under that 65-week moving average, that would be a first since the mid part of 2011, and that would also break this overall trend here as well. So that's something to keep an eye on. All right, we're going to wrap it up with the dollar. Let's take a look. Let's see. In the dollar, you can see, we're going to try to pay back the rest of the world our huge debt by deflating the value of the dollar, right? Pay them back with less dollars. That's been a policy since this country started, right? And here we have, you can see the longer-term trend on the monthly charts intact on the downside. On a weekly basis, we have a very interesting upward channel, right? The bigger channel is this to this. This week, we tested the lower end of this rising weekly channel within that monthly channel and closed right on it. Now, yes, we closed under the 65-week and under the 200-week, but we did hold the bigger trend. This trend line here broke the trend of the up move, but it's certainly possible to get a throwback move back up to the 23 level. Now, the reason why we're talking about this rally really shows up on the daily chart. A couple things have occurred on the daily chart. Number one, you've had what we call a slingshot pattern. We made new lows, new 60-day lows, closed on the highs, and now have confirmed with a move with huge volume to the upside. It also coincides with a test of the lower end of the Bollinger Band and a reverse breakout through it. That's also positive. In addition, we've worked where we went to oversold levels. We still have plenty of room to work it off. So at a minimum, if these lows stay intact, we can easily see a move back up to the 200-day moving average. First stop would be the 50-day moving average, but ultimately, certainly a move back up to 22.25 is in the cards if this thing holds and plays out. And that's also interesting, considering the scenario that's playing out on Capitol Hill. You would think that potentially the dollar would be under more pressure, not less, considering that there could be a downgrade, or who knows how the credit agencies react to this fiscal cliff. So again, looking at that, the longer term view on the weekly charts, you can see 22.85 level also coincides, within a couple of months up here, or at least another month or so away, around this return move to the trend line where this thing broke down from. So again, if you're going to play this, all bets are off if we take out the recent lows. On the other hand, you've got a potential tradable, I wouldn't say long-term bottom, because certainly you can't argue with the longer-term trend in the dollar. But you could have a good counter trend in the making. All right, well, listen, have a great holiday. Hope you enjoyed this, and see you next week. Don't forget to sign up for my Market Outlook newsletter, and you get to enjoy this every week and participate as well in our investor sentiment survey. Thanks, and bye for now.